Hello everyone, today we would like to present BF31703 Bank Lending Assessment and Management Semester 2 Section 2024-2025 Group Assignment. We are from Group 17 IOI Corporation Berhad, prepared to Dato Dr. Rafiq bin Idris, Professor Dr. Wong Hong THIEN. We are Group 17. My name is Anbhu, son of Kumar. My metric number is DB22161105. Today I would like to present probability ratio. Profitability ratio assesses a company's ability to generate earnings relative to revenue, assets, and shareholder equity. One key metric is the return of equity ROE, calculated using the formula ROE equal to net income divided by shareholder equity times width by 100. ROE declined from 16.16 in 2022 to 9.5% in 2024, indicating that company ability to generate return from shareholders' investment has weakened over time. This could be attributed to declined net profit or growing equity balance without a proportional rise in earning. The return on asset ROA, which show how effectively a company uses its asset to generate profit. It is calculated as ROA equal to net income divided by total asset times by 100. ROA also showed a downward trend from 9.23% in 2022 to 6.16% in 2024. This suggests that IOA corporation asset base is not being utilized as effectively to generate income, possibly due to overinvestment or reduced profitability. The gross margin ratio, calculated as gross margin equal to revenue minus cost of sales divided by revenue times by 100, fell from 24.69% to 18.73%, while the profit margin ratio equal to net income divided by revenue times by 100 declined from 11.35% to 9.49% over the same period. This reduction reflects increased cost of pressure or declining selling price, which are common in commodity-related sectors like palm oil. However, maintaining a profit margin close to 10% shows that IOI Corporation still has a relative strong cost control practice. The earning per share EPS, which indicate net earning attributable to each outstanding share, as in calculated as EPS equal to net income divided by number of share outstanding, decreased significantly from 27.74 cent in 2022 to 17.88 cent in 2024. This decline mirrored the drop in net profit, although the EPS has remained stable between 2023 and 2024, showing sign of earning stabilization. The payout ratio, which is payout ratio equal to dividend per share divided by earning per share times by 100, increased from 50.47% in 2022 to 61.28% in 2023 before dropping slightly to 53.13% in 2024. This reflects a consistent dividend policy, suggesting the company remained committed to rewarding shareholders despite reduced earnings.
My name is Veanthen and I am presenting liquidity ratio. Liquidity ratio means a company ability to meet its short-term obligation. So in current ratio, the formula is total asset divided by total liabilities. So this is the calculation. In conclusion, a highest ratio was better because the company was more short-term asset than liabilities, making it better able to cover its short-term debt without needing long-term asset or external funding. Next, gearing ratio is the financial leverage of a company. First, debt to equity ratio. The formula for this ratio is total debt divided by shareholder equity. So this is the calculation. Next, debt ratio is total debt divided by total asset. This is the calculation. So for these two ratio, a lower ratio was better because the company has less debt to repay, which can make it more stable during the economy downturn. Next, efficiency ratio is how effectively a company utilizes its asset and resources to generate revenue. Asset turnover ratio is revenue divided by total asset. So this is the calculation. A higher ratio was better because the company is using its asset more efficiently to generate sales. Last, leverage ratio is a company ability to cover its debt obligation. First, interest coverage ratio. The formula for this ratio is profit before tax plus interest expense divided by interest expense. So this is the calculation. In short, a higher ratio was better because the company is in a strong position to manage its debt-related costs. Second, debt to capital ratio. The formula for this ratio is total debt divided by total debt plus shareholders' equity. So this is the calculation. A lower ratio was better because the company relies less on debt, reducing financial risk and making it more stable during the economic downturn.
My name is Nurul Anis Binti OMARALI, and I'm going to present the strength and the weakness of the company. The strength of the company is two. The first one is strong liquidity position. The current ratio has steadily improved from 2.43 on 2022 to 3.00 on 2024. This indicates the company has more than enough current asset to cover its short-term liabilities, reflecting good short-term financial health and the ability to handle unexpected expenses or downturns. Next is low gearing and reduced financial risk. The debt to equity ratio decreased from 0.37 on 2022 to 0.33 on 2024, and the debt ratio remains low and stable at around 0.21. This shows the company relies more on equity than debt to finance its operation, reducing financial risk and interest obligation. Next is the weakness of the company. The first one is declining profitability. All profitability indicators, return on equity, return on asset, profit margin, gross margin, and earning per share have shown a consistent decline from 2022 to 2024. Example, return on equity dropped from 16.16% to 9.50%, and then earning per share fell from 27.74 cent to 17.88 cent. This indicates that the company is generating less profit from its resources and shareholders' investment over time, which could concern investors. And next is declining operational efficiency. The asset turnover ratio decreased from 0.88 on 2022 to 0.65 on 2024. This suggests the company is generating less revenue per unit of asset, implying less efficient use of its assets to generate sale.
Hello, my name is Nori Sharatun with ISMAIL. For my part is recommend or suggest whether or not the bank can offer loan facility to the bank. Yes, we recommend the bank should consider approving the loan facility because ROE and profit margin drop still profitable. Current ratio improved, so strong ability to pay short-term obligations. Debt to equity ratio reduced and debt ratio stable, so low debt levels, which is give lower risk for bank. Company not highly dependent on external financing. Asset turnover fell, slightly lower efficiency may reflect asset investment need monitor in future. High coverage, company can easily pay interest on debts. The company is financially stable with strong liquidity, low gearing, and consistent profitability. We suggest loan approval with condition like maintaining a minimum current ratio and regular financial reporting to manage any future risks.
Hello, I will present about factor of financial strength. First, let's talk about our liquidity position. Our current ratio has improved steadily from 2.43 to 2.97 and is now above 3.00. This means we have over 3 ringgit in assets for every 1 ringgit of liabilities. Demonstration strong short-term solvency and enhancing lender confidence. Next, we see how gearing and strong financial stability. Our debt to equity ratio and improve slightly from 0.37 to 0.33, while the debt ratio remains stable at 0.21. Although our interest coverage ratio has declined from 15.77 to 11.59, it remains comfortably high. It remains comfortably high, suggesting that we're still in a low risk position when it comes to covering interest obligations. Lastly, our profitability, although declining, is still within a healthy range. Return on equity dropped from 16.16% to 9.50%, and profit margin from 11.35% to 9.49%. Despite this decrease, these figures are still indicate of solid financial performance. Now, let's shift focus to the financial weakness and risk we have identified. Firstly, their concern with decline probability. Our return on assets has dropped from 9.23% to 6.16%, and earning per share fell from 27.74 cents to 17.88 cents. This is reflective of shrinking margin, both gross and net, which could be driven by increasing costs, market saturation, and operational inefficiencies. Secondly, we're seeing reduced operational efficiency. The assets turnover ratio has fallen from 0.81 to 0.65, indicating we're generating less revenue per ringgit of assets. This may suggest idle assets or a slowdown in sales, which is something we need to investigate further. Lastly, the overall risk outlook show a downward trend in both profitability and efficiency. However, It's important to note that this risk is mitigated by our strong liquidity position, low debt levels, and robust interest coverage. Thank you, and I will any question or feedback.
Thank you.